From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. So we play the yo-yo game. We're back with 2 rate cuts on this slate. Equities continue higher. Apple is slightly better offered as Warren Buffett trims his position, but it's still going to be at the very core of Berkshire Hathaway. We're going to count you down to the market open. That kicks in just under 30 minutes time. Coming up on the show. Coming up, futures moving higher after 2 consecutive weekly gains. The Oracle of Omaha sending shares of Apple lower this morning, and the bond bulls brace for a busy stretch of Fed speak and Treasury auctions. We begin with a big issue. Goldilocks starting to make a comeback.
This story of, pressures easing up a little bit from the rate side and that Goldilocks narrative. It feels like it's a bit of a catch-up trade from those parts of the market that have lagged. And that's not just globally. I think you can also look at some of the lower quality parts of the market in the US that have lagged. It's very hard for it to go directly from too hot to too cold. So you do get that bit in the middle where it does feel just right. That can be pretty short-lived. But for now, at least that feels like where we are.
Joining me now is Dana Dioria of Envestnet Solutions and Guy LeBas at Janney Montgomery Scott. So here we are. We pivot from Friday morning, waiting for the jobs report, to hailing Goldilocks' return and 2 rate cuts. It's all just a little bit too much too soon to get that enthusiastic. Guy, good morning. Do you believe that Goldilocks is making a reappearance?
Good morning, Manus. So I would describe the sort of 3 core events of last week. The Treasury's announcement not to increase coupon volumes, the Federal Reserve's announcement on Wednesday afternoon, and then, of course, payrolls on Friday morning. I would kind of attribute one thing to all 3 that they had in common, which is that they effectively cut off some of the right tail risk for interest rates. So Goldilocks is perhaps a little bit too strong or too confident of a term, but what they did is they served to reduce some of that downside risk. And I think that's one reason to be heartened, at least, and one reason why we think interest rates can continue falling for a little while here. Not massively so, but a little while in the short term.
And that plays right to the thinking, doesn't it, Dana, which is cutting off the right tail risk, which is perhaps no further narrative about hikes, repricing rate cuts. But with that in mind, do we now need to reconsider deceleration relative to disinflation?
Yeah, I think that's always been a concern, and it's one that, because the fight seemed to be centering around inflation, obviously inflation being sticky, I would say, not yet spiking, obviously, but certainly not necessarily under control, that, take the eyes off the ball a little bit on what's going on with growth. And of course, GDP growth didn't come in fantastically well. Now, of course, we know there's subject to large revisions on that, so we'll see. But also a little bit of obviously softer of an employment report. We've been in this hiking cycle for the period of time now that suggests that if there are going to be some concerns in the economy, they would start showing up. But that said, these are pretty lightweight cracks that we have so far.
Yeah, they are. 175,000. The wages lighten up a little bit, but then it was all undone, or materially undone, by the services report. We'll come back to that in a second, because traders really are bracing for a fresh round of Fed speak. Mike McKee is with me to set that agenda. What have we got today, Mike?
Well, what we're looking at, Manus, is what Austin Goolsbee, the Chicago Fed president, told me last Friday when we talked to him out in California. It's time to sniff. Everyone thinks it's a battle between dovishness and hawkishness. It's not about the birds. It's the data dogs. The first rule of the data dogs is to know when to walk and when to sniff. So we're going to have a lot of people out there talking about what they're sniffing in the economy, starting with Tom Barkin and John Williams today. We had a little bit of a surprise essay out from Raphael Bostic this morning, but he did not talk about the economy in that. The yellow names there are the ones where you're going to want to really pay attention, because they are talking about the economy. The others are talking about things like college graduation and the idea of becoming an economist. So they won't make a whole lot of news. But the question is, if they're out there sniffing, what are they going to sniff? Not a whole lot this week. It's a pretty dry economic calendar, except for jobless claims and Michigan sentiment on Friday, neither of which is probably going to move the markets unless we get a big surprise in jobless claims. So where we are is kind of where we probably will be with the idea of what's the Fed going to do. Even if people say something, they can't really go ahead of Jay Powell and say they're going to go up or down. So Fed funds futures are where they were basically before the jobs report, talking at this point about the idea of a November cut, maybe a September cut, but nothing before then. So we'll keep an eye on that. But this week, a lot of talk, but can they move markets? Can they convince investors of something?
Well, I think the market's going to be counting down to CPI. I mean, there will be those nuances and twitches, Mike, won't there, as they speak, but it really is all eyes and ears down to the CPI numbers, the next one. Dana and Guy are still with me. So here we are. We're looking at this jobs report from Friday, and you can take of it from what you want. But one thing that struck me in one or two reports that came through, full-time hiring has breached negative levels on a year-on-year basis. Outside of recessions, that's only happened in 2010. How quickly can this become undone? Guy, let me take it to you first of all, because the services number was the lowest in 4 years. Prices paid spiked a little bit higher. There are these incremental fissures of warning on the horizon, aren't there?
Yeah, it's hard to look at the economic data and not notice these little pieces of downside. You're certainly right about that, Manus. But there have been, for the last 2 or 3, maybe even 4 years, where we've been in a period of, by and large, rebounding economic growth from the COVID downturn. These sort of strange, almost hard to explain echoes of negative economic data that just haven't been realized. And I think part of this is some of the noise that's been introduced by the economy that's so rapidly shifting between different components of supply and demand, as well as between seasonality factors. So I hate to blame them in the long run. In the short run, they can make a lot of difference and get things kind of sloppy. So I'm not convinced there's a lot of evidence of economic downside. And back to Dana's point a couple moments ago, first quarter GDP growth on the headline was a little bit on the soft side, but on the core side, when you look at real final sales to domestic purchasers, was very, very strong. I mean, it was a full percentage point above the trend from 2010 to just pre-pandemic. So I don't see the very obvious signs of economic weakness. I'm not ready to accede to that point, not yet anyway.
And I mean, yes, I get that point, Guy, but I think when you look at those post-pandemic or those pandemic savings, they are turning negative for the first time. So it's not about what is now, it's about perhaps where we go in the next 6 months. Dana, and to that point, the question is, will I look back at Friday and have the horrors of maybe that was one of the last or one of the final moments when I could add duration very, very comfortably to the portfolio?
I think there's going to be a lot of volatility, but it depends, of course, what your time frame is. But I wouldn't necessarily say that's the case just from the standpoint of the volatility that I think is going to come through with the data. I think everything is very much hinging, and that's why you're seeing such kind of interesting swings in both markets, right, around just data points that, so the discussion we're having here, they could have meaning, they could be signaling a trend, but they also could just be kind of bumps that don't really materialize into anything. So I think it's hard to say that, you've lost your opportunity set in that respect by any stretch. I think we're going to be very data driven as we move through the next several months. And, again, we saw first rate cut expectation in December, now pulled forward to November. There's plenty of chatter. We don't get any rate cuts at all this year.
And I'm drawn to the point that you make, Dana, very clearly, which is it's almost like a silent QT. It has the rate of QT is going to be drawn down from 60 billion to 25 billion. But as you would say, that is almost a form of subliminal easing.
I mean, it is, but it's not a big one. And it's let's face it, it was already happening at a glacial pace, right? So I don't necessarily expect that it's going to have a massive impact.
Does it cap the longer end? Does it perhaps cap the longer end, the 10s and 30s?
Well, I think to a certain extent that's some of the intention, right? But I don't know that again, you're talking about something that we're talking increments here on a monthly basis, and mixed in with all of the other things that move those rates, which are many, right? With what's going on, just expectations about economic growth. You could have an AI blowout that sort of changes all that. So I think, all else equal, there's some impact there, but it's very minimal. And, when you look at your claims that does the Fed kind of try to swing things in terms of from a political perspective or help, one administration or the potential for another, I think you have to look at it and say, you're not seeing a lot of that, right? We've got a federal deficit where it is, and the Fed coming out and saying, no, higher for longer, and we're really going to be focused on our mandate, which is inflation employment. So I think what's happening in quantitative tightening or, a little incremental easing to the tightening is very incremental, I'll say.
Yeah, I mean, it's small in numbers, but perhaps it's just there in the background. Guy, it's interesting when you listen to Powell pushing back at the press conference about silence to politics. That's not what they're there for. Their job is to manage and to carry through at all costs. It was a very, very robust pushback. The market has repriced, hasn't it, in the space of 48 hours of trading, we've gone from practically zero cuts to one cut in deck to NOV to SEP. So this momentum is building. Do you think 2 is a fair insurance set of cuts for 2024?
Yeah, sure. I mean, 2 is a good guess. Well, let me just take the political comment for a moment. I think there's this long-running expectation the Fed is a heavily political body just because it fits certain predetermined narratives. Over the last 11 election cycles, which the Federal Reserve has been active, presidential election cycles, they've been hiking interest rates in 6 of them and cutting them in 5, and there's a handful of others in which they haven't moved them. So the data the history doesn't really suggest that they're particularly political. Second, in terms of what to expect for this year, first of all, in the short term, the inflation data have proven really, really hard to forecast, genuinely so. Our models have been wrong, frankly, the first couple of months of this year, just as they were wrong the other way the last couple of months of 2023. So it's hard to say. I have low confidence, but 2 seems like a reasonable number. 6 heading to the year was patently absurd, and one reason we were advocating a shorter duration position heading into the year. 0 is probably unlikely. There have been a handful of mid-course corrections in the Federal Reserve's history, the most obvious of which being the 1995 episode. And essentially all these mid-course corrections were 75 basis points of rate cuts over the course of 2 to 3 quarters. Whether it starts in September or December, it's probably going to be that same 75 basis points and last 2 to 3 quarters. And so it's a little bit easier to take a position on that, not by necessarily betting when that rate cut starts, but rather about how large it's going to be and what that's going to do to intermediate to longer term interest rates.
I love your honesty, patently absurd. But then that's what irrational exuberance perhaps looks like in a rates market. Dana, to close off with you, I mean, would you concur with Guy that we're perhaps preparing for 2/3? And what does that do to risk? I mean, if I look at risk assets, they have had a lovely extra wind between Friday and today.
Sure, because I mean, we're pricing in all of a sudden no rate cuts. I would agree. I think all else equal, that's probably around where we stand. I'd say maybe 1 to 2 right at this moment, but there's not a lot of information content on what we're able to say right now for what's going to happen in September, of course. And to your point on risk assets, I think anything that suggests that there's more cuts than was previously expected could be a real boon to small caps. They're obviously more interest rate sensitive. They've obviously suffered with corporate, have the teams having to go back to capital markets for funding. So yeah, the suggestion that there could be one more rate cut is probably going to be very helpful to assets like small caps.
Well, my favorite fact of the day from Bloomberg is apparently we're making $2 million per minute on treasuries. It's putting the positive back in positive. So all eyes down for 125 billion bucks worth of supply. Thank you both for setting the table this Monday morning in terms of Fed speak and the agenda. That is Dana Dioria and Guy LeBas. Thank you very much. Joining me now for the stocks ahead of the opening bell, Jess Menton is on set. Jess, what have we got?
Good morning, Manus. We have another busy week of earnings. Even though we've already had about 80% of the market cap for the S&P 500 having reported, we have another 4% or about 56 companies. Disney, of course, fresh off that victory from its proxy fight, and Arm, Uber, Airbnb, and Palantir. Of course, I have to point out Berkshire Hathaway shares Class B, looking at that stock up about 1% pre-market trading after Berkshire held its annual shareholder meeting where Warren Buffett, actually, his conglomerate, reported a nearly 40% surge in year-over-year operating margins for the first quarter. But the big news, of course, looking over at Apple, Berkshire did trim its stake in the company, one of its largest positions since Buffett's deputies first invested in it in 2016, though he did say the figures do underscore the difficulty his team have had trying to find worthwhile investments. If you go and look at Apple's stock, up actually down about 0.4%, but it is coming off of its best week relative to the S&P 500 since July 2020. And then, of course, there is Paramount. Berkshire cut its Paramount exposure entirely at a loss. This does come after the New York Times did report on Sunday that Paramount Global has agreed to formally begin negotiations for a buyout group led by Sony Pictures Entertainment and Apollo Global Management. If you look at that stock, it's actually up close to about 5% in pre-market trading, Manus.
Okay, Des, thank you very much. Keeping an eye on the movers. Coming up on the show, tensions are heating up in the Middle East.
I think that there are efforts that are happening right now and could reportedly be announced within the next couple of weeks that are designed to end this.
The Israeli army telling civilians to move out of Rafah. We discuss next on Bloomberg.
The Biden administration is working assiduously on getting a deal with Saudi Arabia that would require relations with Israel and would also, according to reports, require that Israel wind down this war. So I think that there are efforts that are happening right now and could reportedly be announced within the next couple of weeks that are designed to end this.
The Israeli army telling civilians to move out of Rafah. This as it prepares to launch an operation in the Gazan city. The spokesman for the Israeli Defense Forces sending a warning to Hamas on X a little bit earlier, saying the army will, quote, will act with extreme force against the terrorist organization in your areas and residents. Bloomberg's Bobby Ghosh joins me now. So a very clear warning that this situation, Bobby, is almost feeling as if we're coming to some kind of crescendo. This is everything that the world has been concerned about, an attack on Rafah, and now we understand there's an attempt to move people from Rafah. Where do they go, and how imminent is that, let's say, that move on Rafah?
Well, it seems very eminent to judge from the warnings that the IDF is putting out. It wants at least 100,000 people from one part of Rafah to move. They're suggesting that these people move to Khan Yunis, which is a city a few kilometers east and north of Rafah. The trouble is, of course, that Khan Yunis has already been bombed to smithereens. There's not a functioning city to which these people can go. They have to go from Rafah to ruins. And try to set up a life there. And then who knows for how long. And so if you are a Palestinian refugee stuck in Rafah, you're listening to these warnings with a growing sense of dread, but with not many options. It's easy enough for the Israelis to say, we want you to go to this place. There's no there. That's the problem.
Look, throughout and more recently, we've questioned the leverage that Biden and the White House have in this situation. Who has the bigger pressure point to yield here? Netanyahu does not look nor sound like a leader that is ready to yield in any way. And yet at the other side, we have Hamas, and as you say, a divergence between the Hamas, which is in the Gaza Strip, and the Hamas, which is in Qatar.
Well, the political leadership, which is in Doha, in Qatar, and has been in communication through intermediaries with the United States, with Israel, that political leadership for several weeks now had seemed, at least on the margins, more and more interested in a ceasefire deal. But the military command, as you rightly say, the people who are in Gaza, who are run by a man called Yahya Sinwar, they don't seem interested in a ceasefire at all. Just this past weekend, they fired off a bunch of rockets in the direction of Israel. They killed 3 Israeli soldiers. This is a message from the Hamas military leadership, not just to Israel, but also to their political leadership in Doha, saying, you can talk all you want about a ceasefire, we're not done fighting in Gaza. It's a really important moment for Shinwar to be sending this message, because it's basically him saying, I don't care about those ceasefire negotiations. I have my own agenda to pursue here, and I will take my opportunities against Israel whenever they present themselves.
The other dynamic is, of course, the US-Saudi axis. Saudi seeking a security relationship. We know that that's been in the background. That was very close to coming to fruition before this major escalation between Hamas and Israel. This is now being put very firmly back on the table, you understand, by Jake Sullivan, but this is with huge conditionality.
Yeah, so I was at the event in Washington this weekend when Jake Sullivan made those remarks, and I have to say, the way I heard them, they were a little more subtle than is being made out. He did say that the U.S., the Biden administration, would like this to be part of a comprehensive package. The U.S. and Israel, the U.S. and the Saudis make a deal, the Israelis and the Saudis make a deal, and this is all part of one package. If you look at it more closely, though, it really isn't. What the U.S. and the Saudis are talking about are really an old-fashioned defense deal. We sell you weapons, we give you some security umbrella cover, we protect you from your enemies. What the Saudis get from the Israelis is less clear. What the Israelis get from the Saudis is less clear. So my suspicion is that as much as the Biden administration is saying now that this is part of a package deal, it is painting itself with the Saudis into a corner. At one point, the Saudis will turn around and say, listen, we've been very patient. We've been waiting for the Israelis to come in on this. We've set the table for them. But if they don't come, we've got to have this meal between us. We've got to make this deal between us. And I think when that moment comes, the Biden administration will be in a difficult place. They won't easily be able to say to the Saudis that, no, we have to keep waiting for the Israelis to come in.
And of course, a constant message from the Saudi ministers who've been here on a number of times is calling for de-escalation. Bobby, thank you very much. Bobby Ghosh on the very latest in the Middle East. Coming up, the morning calls, and a little bit later, Citigroup's Stuart Kaiser joins me for his outlook on stocks for the second quarter as these earnings continue to roll in on Bloomberg. Morning calls. This is what Wall Street's writing about. Citigroup downgrades Peloton to neutral, pointing to the recent management changes and the upcoming restructuring plans. Morgan Stanley upgrades US Steel to overweight, expecting the shares to benefit from new growth initiatives. And finally, Baird upgrading Micron to outperform, highlighting positive pricing trends and an attractive valuation. Coming up, we're going to catch up with Stuart Kaiser on the rising discussions of stagflation or not, as the case may be, on Bloomberg. Carry on with risk. We're bid up this morning after a pretty strong day on Friday as the market reprices 2 rate cuts for this year, a little bit earlier and more aggressive than we had anticipated. Apple's a little bit better offered this morning. Warren Buffett makes it clear that whilst they've shaved their position, it's still at the heart and potentially at the heart one of their biggest holdings. There is the opening bell, up 0.5% on the S&P 500, and the Russell goes slightly better and broader bid, up 0.75%. That's where the alpha is this morning. To the rest of the markets, you can see, look, the dollar had a pretty brutal week at the end of last week, one of its worst week in 2 months. The market's beginning to reprice the potential for the dollar. The carry in the US exceptionalism still there. So the dollar is up by 0.4% against the yen. That massive move that you saw last week, Janet Yellen sent a message going, the calls for intervention were a rumor and that they should be rare and with consultation. So we're just pushing back against the intervention narrative from last week. 10-year yields flat at the moment, 449. The duration bus has left the train station. Are you on it as the market reprices 2 rate cuts? And Brent is up by 0.4%. What you're seeing here is, of course, one of the biggest weekly losses since in February last week. We're clawing our way back. Saudi Arabia is raising their prices to Asia for a 3rd straight month. But the war premium is much, much eviscerated in the oil market. One stock to watch, it is Apple. Berkshire Hathaway, as I said to you, reporting that it's trimmed its stake in the company, despite Warren Buffett praising the tech giant. Just Menton is with me. So a little bit of a shave, but it's still going to be at the core, a key part, as he says, unless there is a major, major move in Apple.
And to your point, Manus, traders are looking for whether or not the worst is over for this stock after it technically entered a correction off of those December highs back in March. So actually going into its earnings report last week, that stock was already down more than 10% off of those highs. But of course, as we know, it did announce that historic buyback program that it still has not executed yet, but it did announce this. So when you are looking at this stock, it actually topped 180 last week for the first time in 2 months, where you're seeing that stock now down just about 0.1%. Still down about 5% for the year, so underperforming the S&P 500. But when you are looking at Berkshire Hathaway, did trimming its stake of the company. So this was one of its largest positions since they did initiate one back in 2016. So all eyes are on that. And then, of course, if you look back to last week, though, Apple did outperform the S&P 500 on a weekly basis by the most since July of 2020. So technicians are watching closely to see if that stock can continue to trade above that 180 level, Manus.
Okay, Jess, thank you very much. Lovely piece there, Jess, on the Apple move. Turn to entertainment. Paramount weighs the offer from Apollo and Sony, the $26 billion offer to buy the company. Interrupt the flow. Alex Semenova has the details. So they've got a spoiler alert on the deal flow. Alex.
Good morning, Manus. Well, the saga around who takes the reins at Paramount Global continues. They're now weighing this $26 billion deal from Sony and private equity giant Apollo. This is after it let discussions lapse with Skydance, the movie studio led by David Ellison. It had a month-long negotiation period that ran its course. The New York Times reported that a special committee of the board of directors at Paramount met on Saturday and signed off on these discussions with Sony and Apollo. The committee also reportedly pushed to continue the discussions with Skydance, though non-exclusively at this point. And the deal talks come as Paramount struggles with industry headwinds, including a fall in viewership of cable TV, streaming wars with some of its competitors. Paramount is up about 5% this morning, shares moving even higher right now, but of course down 13% year to date through Friday's close. Important to note here that any deal between Paramount and Sony would face major regulatory hurdles. The government prohibits foreign ownership of broadcast networks, and Sony is, of course, based in Japan. The New York Times reports that that Apollo would push to have a license of CBS broadcast operations if this deal moves forward. Manus.
Alex, thank you very much. It's going to rumble on. Let's turn it over to the airline space. Spirit giving revenue guidance for the second quarter. It fell short of Wall Street's expectations. Nora Melinda is with me. Nora, what is the story for Spirit?
Good morning, Manus. Spirit shares are slipping after already being on thin ice this past year, and investors aren't any more pleased by its latest results. While first quarter results were roughly in line, the budget airline said that it expects revenue for the second quarter to fall somewhere between $1.32 billion and $1.34 billion. That's well below analyst estimates of $1.46. The company is still facing headwinds from sluggish domestic demand and the grounding of dozens of its aircraft. Considering the challenging year it's had, management said that it expects to reach a resolution with loyalty bondholders, quote, at some point this summer. Shares are down 77% year to date, Manus.
That is what you call a brutal move. Nora, thank you very much and welcome to the show. Turning to the consumer space, the former Starbucks CEO Howard Schultz is urging the coffee chain to own its shortcomings, fix your operations, following the biggest sales miss in years. Katie Greifeld is with me. I mean, he has some qualification. He's a pretty significant individual shareholder. Katie, take me through the narrative on LinkedIn.
Yeah, I would say that he knows this company fairly well at this point. So let's read directly from that LinkedIn post. Schultz saying that at any company that misses badly, there must be contrition and renewed focus and discipline at the core. And then he continued saying that one must own the shortcoming without the slightest semblance of an excuse. So tough words from Howard Schultz there. And this coming after, of course, Starbucks reported its first sales drop since 2020. And as you said, I mean, he stepped down from his third stint as CEO in 2023, but he's still the fifth largest shareholder at Starbucks, and he is the single largest individual shareholder. And in this post, he didn't name the current CEO of Starbucks, but he did offer some suggestions, saying that management and board members should spend more time with customer-facing employees, and that also Starbucks should reinvent its mobile ordering and payment platform. He wrote that through it all, focus on being experiential, not transactional. So shares up slightly at the moment, up about 1%. Remember, they plunged 16% last Wednesday, and for the year, they're down 23% year to date, Manus.
Well, I tell you what, the analysts will be happy. When you miss that badly, there must be contrition and a renewed focus on discipline at the core. Katie, thank you very much. A message from the former CEO. Our next guest writes this. We don't see stagflation as the most likely outcome, and similar to soft landing in 2023, its definition is in the eye of the beholder. Stuart Kaiser is with me, head of U.S. equity trading strategy. In the eye of the beholder. So give me the eye of the beholder and what this soft landing 2024 is going to look like. Stuart, good morning.
Hey, Manus, how you doing? Look, I think after that first quarter GDP report, we started to get these kind of stagflation, commentary and questions coming from clients. And I think one of our pushbacks has been, what is that? And I think from our perspective, it would be below trend GDP with inflation that's kind of above target. And that's probably a little bit less negative than some other people would define it as. So, definitely an ongoing debate in the market about how do you invest if you believe that stagflation sort of outcome is going to happen.
Well, I presume commodity and energy is going to be part of that narrative if I believe that there's a portion of stagflation.
Yeah, I think, energy and the materials sectors would definitely kind of fall into that. Obviously, you end up with kind of a trade-off there. I mean, those do tend to benefit from higher inflation. But if you were to get a significant slowdown in growth, those are parts of the market that would be under pressure. So I think to think the commodity space will work in a quote-unquote stagflationary environment, then you have to kind of be in our camp, which is positive growth that's also below trend. So you're kind of like threading this needle of you've got some growth, but not a ton, but you're also kind of avoiding recession at the same time. So definitely threading a needle, which I think is why it's such kind of a confusing investment environment for a lot of folks right now.
I like what Guy LeBas had to say to me a little bit earlier, which was the right-hand tail risk, in his view, has been taken off the table. And that right-hand tail risk is, of course, rate hikes.
Yeah, I mean, that's what the Fed is, I think, trying to guide you in that direction last week, that, the bar for them to hike is extremely, extremely high. And it's obviously driven by probably a hook higher in inflation as the year goes on. And, that's definitely not the outcome they want. And it's not the outcome that they want investors focusing on. I mean, my takeaway from the Fed last week, I know a lot of people are trying to call it very hawkish or very dovish, but I actually think Powell's goal was to actually keep people in the center lane on this one. They don't want the market overreacting to growth data. They don't want the market overreacting to a couple inflation prints, and I think they'd still like to get a couple cuts off if they could. So, hawkish or dovish, I think what Powell was trying to do is keep people kind of center lane, to be completely honest.
Look, a lot of people have used the phrase U.S. exceptionalism, and it has been correct and worthy, absolutely for the dollar, absolutely for U.S. equities. But when it comes to exceptionalism, this is what we had from Academy a little bit earlier on. I'm just going to read it to you, which is, I like my exceptionalism to be exceptional. Normally, we would agree that there is a transition period from everything is great to everything is bad. And I do wonder if we have more of a gap than a transition. Of course, this is Peter Cheer over at Academy. That's the risk, Stuart, isn't it? That, everything's grand, everything's good, everything's fine. Then you get a wee bit of a twister on Friday with wages, with jobs, with services. And the risk is that we don't just drift a little bit slower to the Goldilocks scenario that you've laid out, but that we gap and drop. Do you see a material risk of exceptionalism being squashed much more quickly?
Look, I think that's the chief risk to the economy, and our economists have also highlighted the risk of, that payrolls can deteriorate, quite rapidly. If you look historically speaking, there are less months where payrolls is between 0 and 100K than there are when payrolls is negative. So sort of that middle ground there, that transition period, those tend to be fleeting and pretty short. So, that is definitely an underlying risk to the market. I'd say, the labor market and consumer spending is the number one risk that we're focused on from a macro perspective. So, I would agree with that logic, and I think the historical data lines up with it. You just don't have very many transitions that are slow and easy. They tend to happen, quickly and sort of painfully.
Yeah, and depends what kind of left tail risks come at us. And you very clearly focus in on the average hourly earnings as well, being sub 4%. And that's part of the narrative for you about the slight slowdown.
Yeah, without a doubt. I mean, the first quarter GDP, the employment cost index, some of these sort of subcomponents of the ISM indices have definitely been hinting towards wage inflation. And I think a lot of folks were worried about that being kind of like the next leg of inflation. So seeing that average hourly earnings kind of decelerate this month and 2 of the last 3 months, to be completely honest with you, I think was pretty reassuring. And I think that's why the markets responded so positively. I don't think equity markets traded up because of 175K or because of 3.9% unemployment. I think it was because the headline payrolls were strong enough, and you also got a little bit of relief on what's been the bogeyman for the markets over the last couple of weeks.
We listened to the Berkshire Hathaway narrative over the weekend. Cash is a huge element for Warren Buffett, possibly because he wasn't able to deploy and to do deals. But it's earning nicely for him, $1.9 billion. How intransigent, how sticky is cash in the CDs and in the deposits? How hard is it going to be to prize me away from cash, Stuart?
I think it's good. I think it's a high bar for that right now, Manus. I mean, if you look at retail money market balances, you had about 28 billion of outflows right around tax season, and then you're sort of back to inflows. And if you look at the size of the outflows around tax season, they line up quite nicely with the taxes you would have had to pay on 5% interest on the balances of those money market funds for the last 12 months. So, look, given the degree of uncertainty out there, it's going to be hard to get people out of 5% cash, and partly because we just haven't seen 5% in a while, right? So people kind of need to get a little bit used to it. But, our view, as has generally been that if you're growing earnings 10% plus, that you should have money in equity markets. And ultimately, we do think that money will come out. But it's going to be slow, and it's going to be a heavy lift to get money out of that 5% cash. Agree with that. And, to Berkshire's point, there's also maybe not as many high risk reward investment opportunities there. So from a risk reward perspective, clipping that 5% coupon has just been the right place to be for a lot of investors.
It's the sweet place to clip the coupon and march on. Stuart, thank you very much. Stuart Kaiser there of Citi. On the markets this Monday morning. Coming up, Robinhood receives a Wells notice from the SEC. What does it mean? We'll discuss the fallout in just a moment on Bloomberg. Check on some of the stories that are moving in the world of finance. Shonali Basak joins me for that. Checking in on Robinhood. Stock is flat at the moment, so it's batting away this Wells notice, Shonali, that we understand. This is around their crypto business. So what exactly is the Wells notice referring to, and how much impact might it have?
Could have a significant impact only in that, Manus. You have an issue here where crypto has been a growing part of Robinhood's business. Why is the stock shaking off the worries about an LCC Wells notice, really indicating enforcement actions tied to this cryptocurrency business at Robinhood? You only have crypto as less than 15% of the assets under custody over at Robinhood in the year ended last year. And so Robinhood does report results in a couple days after market, that is Wednesday after market, and we'll see whether the crypto business has been growing just as meaningfully, but of course it's volatile business as well. It's a really small part still of the overall business, but you have to remember, when you look at last year and the prior quarter's performance, they did show a decline in transaction volumes for the main businesses, equities and options, whereas crypto had a massive jump, both by the amount of volumes per transaction and the transactions themselves. So Robinhood is looking to fight the SEC on this, and they're not alone. As we know, other cryptocurrency firms are also looking to fight the SEC when it comes to their concern over crypto.
Yeah, well, certainly everybody's had a few run-ins with Gary Gensler over this. And just to make it clear, is that the CFO there, Dan Gallagher, said they firmly believe that the assets listed on our platform are not securities. So talk to me a little bit about, we've got a new credit. Everybody wants a piece of the credit pie. Everybody wants a piece of this. The banks are fighting to keep it, and there's new entrants combining. PNC and TCW are combining to create a new platform. What is it? Size, scale, scope?
Take a look at PNC shares this morning as well, because you do see them hopping on the heels of this news, up about 1% or so. This, or pairing those declines now about 0.6%. You have PNC, one of the largest regional banks in the country, looking to pair with TCW, traditional bond fund manager, as it's known for, looking to get into private credit, one of the biggest moves by CEO Katie Koch in the early years since she's taken over. And remember, recently we've seen this kind of deal happen with other large banks, Barclays, for example, and AGL. This one is a little different. They're trying to put together about $2.5 billion in equity in year one when it comes to these deals. So certainly you see the regional banking system pairing up with private credit in a significant way, these deals crossing the tape at a greater speed as we hit through the year.
And let's just round off. I mean, we had a weekend of theater with Warren Buffett talking about not just his lost partner, Mr. Munger, but talking about Apple, talking about cash. And they're two of the big bulwarks of this story. I mean, they're earning plenty on the cash, and Apple will be a core holding in the future.
You had Warren Buffett really...
It still is, but it's not going anywhere unless something materially happens.
Yeah, he said it will be, by the end of the year, still likely the largest holding, and he likes it even better than the likes of some of his other favorite stocks, American Express and Coca-Cola. But one interesting thing here, Manus, is preparing for the future. This hint that he gave about the idea of selling some of the Apple stock before corporate tax rates might get larger, tax rates for investors might increase in the future with the government debt load where it stands and the U.S. needing to pay for its fiscal responsibilities, if you will. He said that if investors looking to see higher tax rates ahead might not be so sad that you're selling Apple today. But of course, as you say, really, not only did they make the most of its money, not just from the profits of selling stocks, from their cash hoard, and of course, Berkshire, standard of the American economy, off of its operating earnings, where they saw many increases by the billions for most of its core businesses.
Yeah, well, certainly Geico and the insurance side of the business doing very nicely. Shanali, thank you so much. That's rounding up the financial stories here on The Open today. Sector price action, let's get across to Jess.
Well, Manus, taking a look at the industry groups in the S&P 500, you have 10 of the 11 groups higher. If you look, what's really driving things is the energy sector. So this does come as U.S. oil prices are rising this morning, actually trying to recover from last week's steep losses. You do have WTI topping about $78 a barrel. Of course, if you look on the other end of this, consumer staples are flat this morning. Have to point out, though, when you are looking at the NY FANG index, that's actually up roughly 4% so far this month, continuing to edge higher this morning. Of course, have to point out there's only been 4 sessions so far this month. But of course, the biggest weighting when you are looking at this particular index is Alphabet. Also, another big weighting, of course, is Tesla and Apple. But Apple's the only one so far this month out of them that have reported. But we do have NVIDIA coming up on May 22nd. So all eyes on that. Have to point out, though, Bloomberg's Mark Gurman has a story coming out about the next big event for Apple's the new iPads that are set to potentially arrive on Tuesday at a big event there. So that's another group we're keeping a close eye on, Manus.
Okay, Jess, thank you very much. Coming up in the show, market moving events to set your clock line. Your trading diary on Bloomberg.
I think every regulator is worried about 3 topics, not just safety and regulation. They're worried about innovation, they're worried about competition, and they're worried about safety and regulation. So when you take those 3 together, the AI Alliance and Open really come together to help you foment innovation. So I think that actually helps the regulators to think about what is going on here. While I caution, there will be some guardrails that are always put, but in my experience, open technologies have always been safer and more secure than closed technologies.
It was a long time ago. 5 days ago, you're trading over 5% on 2-year paper. This market has repriced from 0 cuts to 2 cuts and pulled those forward to September. The consequence, the quid pro quo of this pressure on yields, as we saw the wages slip and the jobs drop, is to boost the equity narrative. The Nasdaq took the crown at the end of last week. Palantir is one of the most strongly bid stocks this morning. So you are looking at a consequence of this. We're off the lows on 2-year paper. Let's just have a look at the stocks for you. This is the score soar at this stage. Again, the Russell is breathing life into breadth because of the view of a cut in rates is to come. Palantir up 5%. Take a look at Dan Ives at Wedbush talking about the narrative there. Nasdaq up 0.5%, and S&P 500 also bid by 0.5%. So we're certainly pro-risk at the moment. Your trading diary looks a little bit like this for the rest of the week. Fed speak, Barkin and Williams, plus the senior loan officers survey. Slews, you'll get that today. Tomorrow we get the earnings from Disney. Uber results hit the tape on Wednesday, and finally the Bank of England rate decision on Thursday. We got there. Monday, countdown to the Open from New York. A very good morning on Bloomberg.